Welcome to our monthly community call on behalf of the Emerson Group, real estate professionals. My name is Nick Emerson. I'm the owner and operator of the Emerson Group, and we specialize in working with income property owners and making sure that we can provide them solutions to their problems and continue to build generational wealth for themselves and their families. So my goal for these calls is really make you a smarter, more informed investor so that you continue your wealth journey and continue to build generational wealth for your families. Today's call is going to be on the Delaware Statutory Trust. So I'm excited today to be talking with Jason McMurtry, who is the managing partner at 1031 Capital Solutions. He's also the author of How to Retire from Being a Landlord. So we're excited today to really get into Jason going over more about the DST. What is it? How does it work? And understanding if it's something that makes sense for you, depending on what your current options are or where you might be heading. So Jason, thanks so much for your commitment of time on this call, and looking forward to really going through the Delaware process and figuring out what this looks like and how it can help people. So without further ado, Jason, I'll let you take over from here.
Yeah, thanks for having me. I appreciate it. As Nick mentioned, I'm the managing partner here at 1031 Capital Solutions. We are technically financial advisors, and we specialize in 1031 exchange transactions and the use of the Delaware Statutory Trust. Co-managing partner is Richard Gann. He's a former estate planning and tax attorney. And I've been in the business for about 23 years. So we co-own and operate the company together. We actually co-wrote the book together, How to Retire from Being a Landlord. And yeah, happy to be here and happy to go through all this information with you, Nick.
Awesome. Well, let's just get started a little bit more about what are the common challenges and why someone would even be considering the DST.
Sure. So we're all very familiar with all the benefits of rental property. Can be a great source of cash flow, appreciation, and tax benefits. But anybody that's been in real estate for any period of time knows that it comes with some certain burdens, and they can be related to dealing with the tenants. They could either have trouble paying the rent. We've had the moratoriums recently. They could tear up the property. There could be legal issues with tenants or other legal issues. Obviously, any structure is going to have maintenance and repair issues over time. And the bookkeeping is more complicated than if you owned a stock or a mutual fund or something like that. Now, most people happily accept these burdens when they're in their working years. It's more than worth it to deal with these issues because of the tremendous benefits that real estate provides. What's interesting, though, is unlike just about every other job, the DST notwithstanding, it's impossible to retire. So I talk to people all the time that have spent 20, 30, 40 years accumulating their real estate portfolio only to find that they're sort of trapped with it. Because what they often think is, if I cash out so they don't have to deal with the tenants, the toilets, the trash, the maintenance, the repairs, the accounting, if I want to escape those burdens, well, that means I sell the property. And if I sell the property, about a third of my portfolio is going to go straight to the government. And so they do that quick math, and a lot of people decide, I'm just going to manage it. You know, maybe I'll get a property manager to lighten that burden a little bit. But even with a property manager, it's up to the owner to write the checks, you know, to make the major decisions about, do I put on a new roof or do I repair it? What do I do with a tenant that won't pay? You have, you know, a property manager that deals with the day-to-day, but you're still heavily involved in real estate. And so these are reasons that people would want to get out of real estate. They just often don't know that there's a way to do it without paying that huge tax bill on the way out. So I already mentioned the number one reason that people don't sell and don't get out of the business is because they believe that if they do, automatically a third of their portfolio goes to paying tax. The other reason that we see frequently that people don't sell is maybe they went out and they got a $1 million loan. So they bought $2 million property, they got a $1 million loan. They collect enough revenue from the tenant to pay that mortgage and have some positive cash flow. Everything's going great. Well, fast forward 10 or 15 years, now they aren't in the working world anymore. Their income is way down, and it could be difficult to refinance that loan. So sometimes people come to us not because they want to get out of real estate altogether, but because they're selling a property, they can't refinance the loan on the property and they're stuck. So DSTs can be a great way to solve that problem. And we'll talk about how a little bit. It's lightening up a little bit, but a lot of our clients over the past 2 years have come to us where they did an exchange, they sold a property, they went into an exchange, and they intended to buy another property. So they were going to do a 1031 exchange, not pay any tax, go buy another property in a better market, or maybe trade up for better property. And they just weren't able to find anything because the market's been so tight. So I've had calls where people are running out of time. They call and they say, I can't find a property and I'm going to end up having to pay tax unless, Jason, you've got something for me. And of course, as we'll get into in a little bit, we have 20, 25 different options that they can invest in immediately. Another reason people tend to not trade, even when it's maybe time to trade, is the burden of going out and finding new property, doing a new escrow, getting a new loan. They're concerned about the timelines, the 45 and the 180-day timeline. They're worried about violating the rules. They got a lot going on in their life, and it's a big undertaking. So they tend not to do that, or they just can't find better property. So these are some of the reasons that we find that landlords want to sell their property and typically do a 1031 exchange, but they don't for one or more. And it's usually a combination of these reasons here.
Awesome. And one thing I wanted to point out, Jason, that I thought was fascinating is that, we have a plan to retire with our job, yet most of my clients don't have a plan to retire from being a landlord.
Right.
So their plan is to remain status quo. And usually that's by default. They don't know what they don't know, and they don't know there's other options available to them. So I just want to make sure that I'm passionate about this, and I'm passionate about working hard and making sure that we have a retirement and a life worth living, and making sure that when you're retired, you've done everything right? We worked really hard our whole lives, our career, to put ourselves and our families in the best possible financial decision and place. And here we are spending our time managing property as a landlord, when quite frankly, most of the people don't even need the money to do so. So I really appreciate this additional option to reinvest, because a lot of us have earned the right to retire, and retirement means not managing toilets, tenants, and trash. And so thank you, Jason, for allowing us the opportunity to learn about this, because again, we work so hard and we want to retire. We don't want to chase around tenants and rent checks. So that's one point that I wanted to make sure I got across to everyone, because I see it all the time where I'm calling people and they're frantic about things they have to do for their rentals, and yet they're in retirement, allegedly. So let's head out just to the basics of a 1031 exchange. And I've acknowledged, Jason, we do a lot of 1031 exchange basics. And so we can do a quick cliff notes on this unless someone has specific questions about it.
Okay. Yeah, the main takeaway here is that when you invest in a Delaware Statutory Trust or a DST, it begins with a traditional 1031 exchange. So it's not like you would do a 1031 exchange or a DST. You're still doing a 1031 exchange. The difference is, are you investing in some property that you find on your own and buying 100% of it, or are you investing in a DST where you'll own a fractional interest in a large commercial property? But all of the rules and everything that you're familiar with in a 1031 exchange still applies. So the property must be like kind, which means real estate for real estate. The key point here is that DSTs, per Revenue Ruling 2004-86, issued by the Treasury, DSTs are like kind property for real estate. There's a revenue ruling that you can hang your hat on. But it has to be real estate for real estate. Doesn't have to be apartment for apartment. Doesn't have to be office for office. You can trade an apartment for an office or vice versa or whatever. But the key point is that DSTs are considered like kind property for 1031 exchange purposes. The proceeds must be held by a qualified intermediary. So it's very important, if you're planning to do a 1031 exchange, that you set up your qualified intermediary account before you close on the sale of your property. couple times a year, I get a phone call from somebody that says, I just sold my property yesterday. Money's in my bank account. I want to do a 1031 exchange. Sorry, you can't do that. You got to get that account set up before. You must reinvest all the equity and replace all of the debt on the property that you sold if you want to defer all of your taxes. You have your 180-day deadline to close on your replacement property. And then, of course, the 45-day deadline to ID. Now, that is critical when you're doing a 1031 exchange into direct property, because you may use half of your 45-day ID period just shopping around looking for something. And then you find what you want, put in an offer on that property, and then your due diligence begins. Then you have to order inspections and appraisals and get all of your disclosures and review all of that. So it's very likely going to be that you're going to go past day 45 while you're doing your due diligence and close sometime after day 45. When we get into it, I'll explain a little bit more. DSTs work very differently. You have all of your due diligence information on day one. The property's already been purchased. So you have your appraisal, inspection, rent roll, the financing, all the disclosures, everything is there on day one. So you look through that, decide you want to buy it, and you can close in a couple of days rather than weeks or months. So the point is you have the same 180-day and 45-day rules, but they're less critical because it's so easy and quick to close on a DST. And then, of course, you got your 3 property rule, your 200% rule, and your 95% rule in terms of what you put on your ID letter. I won't beat it to death because I know everybody here has done 1031 exchanges and familiar. The key takeaway is that all of these rules still apply when you invest in a DST. You're still doing a 1031 exchange.
The only thing I'd add to that is just commonly, if you're reinvesting out of San Diego, we're likely to opt to the 200% rule, which is in essence is we're selling a larger asset and sometimes investing into lower priced assets. So if I sold a detached here and I bought 3 detached homes in Texas, well, I want to make sure that I'm able to put more than 3 properties on my identification sheet. So know that that would be, if you sold $1 million property, you would have an option to put up to $2 million worth of gross value of properties on there. Also, if it's before the 45 days, you do have an option to change the properties out if one falls off. So that's important because I've had people call me on day 44 and a half and ask me about the 45-day period and the properties. And we don't want to be in a position like that where we don't know what we don't know. Right. So perfect. Let's get into the bread and butter of what a DST is.
Yeah, so we've kind of teased it out for a little while. So let's get into what it is. So sometimes people think they got to go to an attorney and set up a trust and do all this. It's really a fund. Think of a DST as a fund. It's structured in Delaware because of Delaware statutory law, but the properties and the investors are all over the country. And from an investor standpoint, it just feels like you're investing in a fund. So it's a legal structure. It has the IRS blessing. I mentioned earlier, Revenue Ruling 2004-86. That's where the IRS came out and said, yes, property held in a DST is like-kind property. And they put some limits and restrictions on what the DST and investors can do. We'll go over those in a little bit here. But it definitely has the IRS's stamp of approval. It is different from a corporation, a REIT, a partnership, an LLC, a mutual fund. Those are all structures that may or may not hold real estate. But just because a mutual fund holds real estate, for example, does not mean it's 1031 exchangeable. It's not, because when you invest in a mutual fund or a REIT or a corporation, you're investing in the entity itself, and that entity happens to own real estate. When you invest in a DST, just like a personal family trust, you actually own the asset directly. You just own it through your trust. And so that's very much the same as a DST. And that's why it's allowed by the IRS. In most DSTs, although not all, the DST manager is a very large institutional real estate investment company. So all of the DSTs that we offer and recommend to our clients, the manager is a multi-billion-dollar real estate investment company that's been around for a long time. It's not Joe and Tom that bought a property and stuck it on a website and they're raising capital through some crowdfunding website. It's not like that at all. These are multi-billion-dollar real estate investment companies. They've been around for decades, in some cases 50, 60, 70 years. They've got track records. They've got billions of dollars of capital. You're really trading up to an institutional level of property. The last one is one of the great benefits of DSTs. The profits and losses pass through directly to the investor. Now, investors usually say, I love the idea of the profits passing through, but not so much the losses, right? I don't want to lose money. Well, this is actually the best of both worlds, because when all is working properly, what happens is the investor is receiving the profits in cash that they can spend, and they're getting the paper losses. So the property is treated just like any other property for tax purposes, meaning the investors enjoy depreciation deductions. So they may be getting cash in their mailbox that they can go spend, but at the end of the year, they're going to get a tax report that says the depreciation was higher than the cash flow, and you get a paper loss. Therefore, you can take a tax deduction, even though you actually made a true profit. Now, that's true for all real estate. If you own a single family rental or a duplex or a 100-unit apartment complex, it's the same thing. You get depreciation deductions, which offset your cash flow, and you can use against other assets as well in some cases. So the DSTs work exactly the same way. And all of that passes through to the investor, which is really important to real estate investors, because the tax benefit is one of the main reasons that people choose real estate over stock and bond type investments. And I want to point out here, DSTs are real estate because that's what you're investing in, but they're at the same time securities. Securities meaning stocks, regulated by the Securities and Exchange Commission. That means to offer these to clients, you have to be a licensed financial advisor with a Series 7 or 22 securities license. It also means that if you invest in these, you have to be what's called an accredited investor. An accredited investor is somebody that has a net worth of at least $1 million, excluding the primary residence, or an annual income of $200,000 a year. If you're married and you're investing together, then the income threshold is $300,000 a year. Now, you don't have to meet the income and the asset test, one or the other. So if I have a net worth of $1 million and I make $100,000 a year, I qualify. If I have a net worth of $300,000 and I make $200,000 a year, I qualify. So you only have to meet one of the two. So that's an important consideration. When people call us, we walk through kind of assets and liabilities and income and make sure that they qualify early out of in the process, so that they're not getting to the finish line and finding out that the SEC is not going to let them invest. But that's an important thing to keep in mind.
Jason, one thing I wanted to mention is, I've had a lot of people come to me and tell me they don't know what a DST is. Their tax advisors never heard of what a DST is. If we know people are using it, we know it works.
Yep.
Why have so many people not heard about it?
Well, so the first thing I'll remind you is going back to 2004, the IRS gave its stamp of approval then, which is a long time ago, but it's 18 years. So it's still a growing industry. $8 billion were invested in DSTs last year alone, and we're on pace to do quite a bit more than that this year. But that's still a small fraction of the commercial real estate market, which is in the hundreds of billions of dollars every year that trades. So it is sort of a niche investment. And I think the reason more people don't know about it is because it's not appropriate. It's not a good investment for a major chunk of the real estate investor population. So if you've got a 40-year-old that's going out and buying and flipping houses, doing Airbnb, and they like to roll up their sleeves and get out there and negotiate deals and finance and refinance properties to buy more, and they're in the active business of real estate, they don't want a DST, because a DST takes all the fun away, right? It's an investment that's really only appropriate for people when they're at the end of their career, they're ready to cash in their chips, they want to continue the income and potential for appreciation and tax benefits, but they want to wash their hands of the burdens of management and ownership. Well, that's a small sliver of the investor population. So that's why it hasn't caught on more. But for anybody that says, I've never heard of this, sometimes somebody's financial advisor or real estate broker or even tax advisor hasn't heard of it. I've run across that before, believe it or not. I would say call a large exchange accommodator, a national exchange accommodator, and talk to a few of them and say, hey, I've heard about this thing. Do you know what this is? They're going to say, absolutely, we do it all the time, because the exchange accommodator is involved in 1031 exchanges. And so a fair percentage of their business is in Delaware Statutory Trusts.
Perfect. Thanks for breaking that down. Let's go over some of the benefits, right, of the DST?
Sure. So I've alluded to some of these already, but just to kind of hit the bullet points here. The number one reason that people come to us for a DST is they want to sell their appreciated property. So very few people come in and just invest cash in a DST. It happens from time to time, but it's usually starting with somebody that has a property or a portfolio of properties they've had for a long time. It's appreciated and they want to get out of it. They want to get out of the management. They want to get out of the COVID moratoriums, the rent control, the just cause, the red tape, the lawsuits, the late rent, the lender hassles. They want to get out of all of that and be in something that is 100% passive. And that's what a DST provides. Obviously, they want to continue the potential for cash flow and appreciation. Sometimes they come because they don't want to go out and fill out a corporate or a commercial loan application. So we have somebody that owns a Del Taco and the loan is up and they just don't want to go through the commercial lending process because it's very onerous. Maybe they don't qualify anymore because of their financial situation. And a DST has built-in financing. If you invest in a DST, you do not have to fill out a loan application. You do not have to make loan payments. All that's done at the DST level. And that's very appealing for somebody who can't or does not want to go out and get another commercial loan or even a residential loan for a single family residence. One of the other main benefits is you can invest as little as $100,000 in a DST. So let's say somebody comes in and they go, I'm selling a property that I've had for a while for $500,000. Well, yeah, right, not much in that range anymore, but let's say $500,000. Well, that means all their cash is invested in one property. That's one tenant that may or may not pay their rent. That it's a make or break. So it's highly concentrated. Well, they can come and take that $500,000 and put it in 5 different DSTs. So you could have an apartment building in Colorado Springs. You can have a self-storage property in Arizona. You can have a medical office in Florida. You can spread your chips around, not only geographically, but sectors, your cash flows diversified. And that you can't really do that if you go out and buy individual properties. So it allows for diversification. When you invest in a DST, you do not go through an escrow process. The property has already been purchased by the trust. So that 3-month period of due diligence and negotiating and financing and all of that has already been done. You get to look at all of the material, the appraisal, inspection, and all of those things to decide if you like the property. And if you do, it takes about 3 days to purchase your interest in the trust. So you don't have this long drawn out process. It's very easy to invest. As I've already mentioned, the tax benefits flow through to the investors. They get their depreciation deductions. We have, right now, I think we have 25 or 26 or 27 DST properties that somebody can invest in today. So when people are sort of running out of time in day 45, or they just don't want to spend months looking for properties, they could call, look at our inventory on our website, talk through some of the options and make a decision in a day or two. Because we have multiple options at any given time. The DST is itself 1031 exchangeable. So you invest in the DST, say you're in it for 7 years, they sell the property, you could take that money and 1031 exchange it back into a single family residence that you find on your own that you rent out to somebody. So you don't have to stay in the DST universe once you go in, it's 1031 exchangeable. And then you have the potential for what's called a 721 UPREIT. This has become incredibly popular since the Biden administration took over because the Biden administration keeps bringing up the threat of doing away with 1031 exchanges or severely limiting them. I personally don't think that's going to happen. The name of my company is 1031 Capital Solutions, so I'm sort of all in on this. So maybe I'm biased, but I don't think they're going to do away with 1031 exchanges. The code is actually 101 years old. It serves a phenomenal purpose in our society. It's not just a tax break. It allows property to be traded from one owner to another to ensure its highest and best use. It generates a lot of economic activity. I don't think it's going to go anywhere. But because there's been a lot of talk about doing away with it, this strategy has really become much more popular in the last couple of years, and it's called a 721 UPREIT. In this strategy, I'm going to oversimplify for time here, but you invest in a DST that then merges into a REIT, a real estate investment trust. And that real estate investment trust never intends to sell all the property. They're going to own and manage that property in perpetuity. You as the investor get cash flow, potential for appreciation, and you have liquidity. So whenever you want to sell your shares in the REIT, you can. So you have diversification, cash flow, potential for appreciation, and liquidity. So it's a good option for people that want sort of a set it and forget it strategy. And the way you get into the REIT is through the DST. So these are some of the potential benefits here.
And Jason, one of the things that you and I were talking about the other day was looking at the DST through the lens of, would this be a sound option in an economic downturn or recession? Right? If we were going to put our chips in a basket, where would we put them, and what would the timing look like of that? And through our conversation, I think we agree that we talked about the term quality, or flight to quality, rather, right?
Right.
So if you could maybe just touch on why we discussed it being something that might make sense as far as an economic downturn or a recession, not proof, but something that will help mitigate the impacts of that as a income property owner.
Right. So let me sort of outline what that term means, flight to quality. So if you think about stocks and bonds, this is the most common use of the expression. When things start getting dicey, like now, like they've been for the last couple of months, investors tend to get rid of the GameStop and go into Microsoft, for example. They increase the quality of their investments. And bonds, the same thing. They get out of the junk bonds, the high yield bonds, and they go into the AAA rated corporate bonds. They do that because when things are ugly, you want to be in the safest investment possible. And the question shifts from how do I make the most amount of money to where is my money safest? And so what that means in the real estate world is that investors what we're seeing right now is a flight to quality. And what that looks like is, let's go back to that example I mentioned earlier. If somebody has a $500,000 single family residence that they're renting, particularly in California, well, what is the quality of that property? How old is that property? What is the potential for deferred maintenance? How soon until there's a problem with the plumbing or the roof or the electrical? What is the quality of that tenant? Meaning, how likely are they to continue paying? What if they get laid off? It's a single tenant. And so there can be a lot of risk in that single $500,000 property. And what we're seeing is people are trading up. So selling that property, doing a 1031 exchange, and just as I said earlier, going into a portfolio. So if you go into 5 different DSTs, you're automatically right there bringing down your risk because now you have diversification. 5 different properties. Well, each one of those properties, the DST properties, might have 1 to 300 tenants. So now you have, instead of 1 tenant, you maybe have 300 or 400 tenants that is supporting your cash flow. You're in different states, you're in different sectors. But all of these properties are high quality institutional properties. So an apartment, for example, we can go through an example in a minute here, but it's not going to be a single family residence. It might be a 300 unit apartment building that was built a year or 2 ago, where the average tenant has a 700 credit score and makes $150,000 a year. So you're increasing the quality not only of your individual assets, but of your portfolio through diversification. And so the recession, which we're already in, we're in a recession, is going to affect all real estate, including DSTs. The question is, to what extent? Is it going to wipe you out? Is it going to make it so you can't pay your mortgage because your single tenant's not paying you rent? Or does it mean you're going to see a slight decrease in value, or maybe your cash flow will dip a little bit or won't grow? So we're seeing a flight to quality in terms of going into DSTs, diversifying, and really purchasing higher quality assets to get through the recession.
Well, I think that would be a good time. I mean, I know there's a lot of restrictions around the information, but I would love to go over an example just to kind of get a sense of what would this look like if we wanted a visual of it. Because I know a lot of people like the idea, but they get caught up on not having something physically to look at or see on paper so they can really understand what something would look like in this DST space.
Absolutely. If I have control of,
go ahead and
you need to give me control, looks like.
Give that to you. There you go.
All righty, let's see.
Pass the torch.
So as you pointed out, and as I mentioned earlier, we're financial advisors. We're regulated by the Securities and Exchange Commission. These are private securities. That means they can't just be sent out to the general public. We can't show them to anybody that we don't already know. We have to develop a relationship with them. What I can do, though, is go through an example of a deal that's already closed so you can get a sense of what a typical deal looks like. So this is an example. It's actually not a live deal. We've got about 27 live deals. This is not one of them. If somebody's interested in looking at a live deal, what that means is we have a quick call. I build a financial profile on them, meaning assets, liabilities, net worth, investment objectives. I put that in the notes, and then I'm able to give access with a username and password, and somebody can look through all of our offerings. But for this call, what we need to do is just look at a simple example. So all I'm doing here is going to my website, which is 1031capitalsolutions.com. Scroll down. By the way, anybody that's interested, you can order a free copy of our book. Don't buy it on Amazon. It'll cost you, I think, $11 or something. We'll give it to you for free if you request it on our website. And then here are some recently closed offerings.
Which is nice because someone can come back to this and take a look at these in more detail, or they can formulate some questions about some of them, follow up with
Right.
you, and you can go over that with them.
Right. So just as an example here, so we'll look at this Fort Collins, Colorado. This is a deal that we closed fairly recently. This was a 300 unit Class A multifamily project. So Class A meaning top level. So has all the amenities, the clubhouse, the gym, the business center, trash valet, so they don't have to take their trash down to the bin. They put it in front of their door. Valet comes by and picks it up and takes it away. They've got Amazon lockers, really a lot of high-end amenities at the property, relatively new. This had about a 50% loan to value on it. So that means if I invest $1 million into this deal, I invest my $1 million of equity, I get allocated $1 million of the debt, which helps me for 1031 exchange purposes. If I had a loan that I need to replace, it's automatically replaced at the property level here. No close, no escrow. The interest rate on the loan is like 3.5%. I think it might have been 3.25. The cash flow is about 4%. So on my $1 million investment, after all the expenses are paid, so that means the mortgage, taxes, insurance, maintenance, repairs, even budgeting for vacancy, turnover costs. There's not a lot of repairs with a Class A property, but they still budget for, something breaks or a crack in the cement or whatever. After all that is accounted for, on $1 million equity investment, I'm making $40,000 a year. Of course, that's paid monthly installments. So this was $50 million. So a $1 million investment into this property represents a 2% ownership. So I invest $1 million, I own 2% of this property through the Delaware Statutory Trust. At the end of the year, I get a tax report that says I own 2% of the property. The revenue was X, the expenses were Y. I get to write off the depreciation on my Schedule E, just like any other property. The cash flow is expected to go up about 3% per year, just like all apartments nationwide. So as we haven't gotten a full year on this one yet, but when we get to a full year, the cash flow is expected to rise over time. Now, a lot of our deals are multifamily. We also have medical office. We have self-storage properties, small portfolios of sort of mixed use, could be medical office and industrial property. Amazon's a big seller here. If you get Amazon on a 15, 20, 25-year lease, sometimes people go, that's as safe as you can get through a recession. Amazon's not going to stop paying. So those are pretty popular these days. And like I said, we have about 20, 25 at any given time, and they come and go. So it might be available for a month or so, and then it's gone, and then it's replaced by others. So when somebody's doing an exchange, we'll have an inventory of 20, 25 options that they can look at.
And one thing I wanted to point out is cash on cash. So what I commonly find when I'm talking to clients about their current asset, maybe a detached home they've held for 20 plus years, it's not leveraged, right? We've got debt that's very low, if at all. And so when we run the cash on cash, which is how much net operating income am I going to make divided by my current equity position minus selling costs, we're finding that the average cash on cash here is between 1.5% to 2.5%. So you hear 4%, and I'm thinking in my mind, from my perspective, wow, so some of these people that are sitting on a 1.5% to 2.5% cash on cash can actually reinvest it, do less, and make more money. Well, that's interesting. Why aren't more people doing it? Well, I don't know.
I would say that the biggest obstacle that we've seen is until they go through the process that I know that you provide for your clients, and so do we, to actually break down the revenue and expenses and get to that number. Most people, if I tell them ballpark, what's your cash flow? They'll say it's 7-8%. You know, that's just and then when you get down and you actually factor in all of these things, and oh, this and this, and oh, and you got to put on a roof in 3 or 4 years. So you got to account for that. And at some point you're going to have vacancy, and you got to account. And when you account for all these things, you get down to that 1.5%. It's shocking to them. Most investors that I talked to in that first conversation think they're getting a 7 or 8% return.
So what we like about that is we're comparing apples to apples, because we know in the investment world, there's a lot of comparison, but usually the comparison is an apple to an orange, because we're not factoring in vacancy rate. We're not factoring in a capital expense budget. We're not factoring in certain things where these assets are being held at a much more accountable level to each line item.
Right.
So outside of that, Jason, I wanted to mention too, just from the establishment of a DST, what is the historical track record? I know we've talked about this in the past. We said about 4.85 to 5.15 cash on cash. Is that still the case, or where are we at with that?
No, it's come down quite a bit. So
Okay.
Historically, if we go back 10 years and we average the cash flow, it's in the 5% range, right? And average annual returns. So if you count the cash flow and the appreciation together, it's about 10% per year. Is what it's been over the past 10 years. Things are changing, right? And so I don't know what it's going to be going forward. The cash flows have come down quite a bit. And the reason for that is there's an inverse relationship between equity growth and cash flow. So as equity has skyrocketed, the yields have come down. And people know this, right? If you go out and you look for a single family property to rent out 2, 3, 4 years ago, you could get a higher net cash flow than you can get today. And that's because the price of the property has gone up so much. Rents have gone up too, but not as fast as the price of the property. So we are seeing cash flows today in the 3 to 4% range. It depends on what market and what sector. I've seen them as high as 5, 5.5 recently, but I would say the average right now is probably closer to 4, 3.5 to 4. Hopefully that's going to start coming up as inflation continues on and rents grow. If you invested a year or two ago, you've seen your rent go up dramatically over the past couple of years. But if you invest today, because you're investing at elevated prices, you're starting off low. And if inflation continues to carry on, well, then you could see that go up over time as well. But your initial cash flows are lower today because equity growth has been so substantial.
Let's go over some of the limitations of the DST.
Yeah, I don't know if we're on the right, there we go. Yeah, show your screen again. I mean the PowerPoint.
There we go.
All I see is you and me. I don't see the PowerPoint.
Oh, you guys don't want to look at me the whole time? Okay, fine. I'll put the PowerPoint up. All right.
There we go. Okay. So I got to rearrange my screen a little bit for that. You're showing your control screen. Not
yeah, let me get that fixed for you. There you
go. There we go. Okay. So as I mentioned earlier, when the IRS gave its stamp of approval for DSTs back in 2004, they put some rules in place. And the heart of the rule is that the DST should not be treated as a fund. It should be treated as a trust that is simply holding the property for the benefit of the investors. So what can a fund do? What can an LLC do, or a partnership, right? We see this a lot with partnerships. You can invest, for example, You could invest your money into a general partnership that owns an apartment building, all cash, in the city where you live. And you look at that property, you love the property, you love the cash flow, you love that there's no debt, and you go, this is a great investment, I'm going to invest in it. In a fund, not a DST, but in a fund like a partnership, that general partner, a couple years down the road, can say, you know what? I don't really like this apartment building anymore. I'm going to sell it. I'm going to exchange it for a strip mall and put an 80% loan on it and go buy some other property as well. And you, as the limited partner, have no say in the matter. You just have to go along with it. So the general partner can change all the terms of the deal. They can change the property. They can change the financing. They can come back and ask you for more money. They can admit new investors, which would dilute your interest. They can do all sorts of things which may be good or bad for the fund. You have no say in the matter. The IRS said a DST is not a fund. Therefore, the DST can do none of those things. So I consider the limitations of a DST to be investor protections. So let's go through them really quickly. When you invest in a DST, the DST may not exchange the property in the trust. Now, this creates a lot of confusion the way it's worded. That doesn't mean that you can't exchange your property down the road. What it means is if you invest in a DST and there's a property in that DST, that's the only property that's ever going to be in the DST. They can't exchange that property for another property. They can't sell it and buy something else. Now, they can sell the property, but when they do, they return your funds to you so that you can do another exchange. So it's a what you see is what you get situation. They may not purchase other long-term assets. Now, the reason it says long-term is because they can put the money in a money market account or a checking account in order to do cash management, but they can't go out and buy other investments that weren't in the fund when you bought it. They may not refinance the loan. So if you've got no loan on the property, they can't add one. If you've got a 30% loan to value at a 3% interest rate, they cannot go refinance that at 80% at a 5% interest rate. They can't do it. They can sell the property and pay off the loan, but then they've got to return the property back to you. Nick, you wiped out the screen. Are you there, Nick? Nick? Is anybody there? I don't know if can somebody say something in the chat if you're still there? I lost Nick. I don't see the screen anymore, and I don't know if I'm alone or if anybody's here. Hi.
Hi, sorry about that. Nick's computer just died. So
Oh, okay.
I can pull up the PowerPoint unless you
Okay.
have it. I can give you control.
Let's see. I can do that. Yeah, give me a second to get to the right page and I will be able to do that. Okay. Do I have control now?
Yes, you should.
Okay. Okay. All right. Can you
Thanks,
see it?
Jason. Yes.
You can see, okay. So this is a little bit of a different format because it's not in a PowerPoint, but this is from my brochure, which, by the way, if you go to the website, you can grab this brochure, same place you can look at the closed properties and all of our other educational assets. Okay. The DST may not accept additional contributions of assets, meaning once the DST closes, you cannot go out and add new investors, which would dilute your shares. No capital calls. This is really important. So unlike a fund, when you invest in a DST, if you invest $100,000, they're never going to come back and say, well, there's a problem with the roof. You need to invest another $10,000 or something. It'll never happen. It's not allowed. Can't renegotiate leases. You can't change out tenants. So if you love the tenant, like an Amazon, for example, they're not going to say, well, they're moving out and Bob's refrigeration is going to move in. Nothing like that. So the short version is there's no, oh, Nick's calling me. This will be.
Oh my gosh.
Hi, Nick.
Sorry, everyone.
Well, so good news. Portia in your office got the thing up and running, and I'm continuing on the meeting here. All right, thanks. Are you going to be back on, or is that not possible? He hung up. Portia, do you know if he'll be able to join us again, or if I'm just going to wrap it up?
I actually don't know, honestly.
Okay.
Technological issues.
All right. This is fun. Live TV. Okay. So the point is you cannot change the terms of the deal, and those are investor protections. In terms of working with us, I don't really know where to go from here because the PowerPoint was, he was kind of controlling that. In terms of working with us, so we're very education oriented and consultative, right? So I know several of the people on the call here are real estate agents. There may be some potential investors as well. We work with a lot of real estate agents to help them understand the 1031 exchange process and how the DST fits into that process. We have found that agents and brokers that incorporate the DST concept into their business are able to tap into a segment of the market that most agents really ignore. A lot of agents are looking for the family of four that wants a slightly bigger house, and everybody's sort of competing for those clients. Well, there's this huge segment of the population, people in their 60s, 70s, and 80s, that do not want to own their real estate anymore. They just don't know that there's another solution. And so if you can develop a way to approach those people and ask the right questions, and you know just enough to kind of say, hey, there's maybe a solution here, and you can either drive them to our website or get me on a call or email or whatever. We talk about how this whole thing works and how we might be able to help them. If it's right for them, and I'll tell you right now, it's not right for everybody. And if it's not right for them, we're going to tell them right out of the gate, you're not a good candidate for this. But if it is right for them, the first thing they need to do is sell their property. And that's where you as the agent come in. And so we kind of work as a team. We talk about what the benefits are, the risks, the limitations, everything we've gone over today. If it's right for them, they go back to the agent, they sell the property, and then we invest the funds into one or more DSTs. Let me go back to my website for a second. So if you go to our website, which is 1031capitalsolutions.com, and you go to the resources tab, we've got articles, videos, literature. We've got lots of videos that cover different segments of 1031 exchange and DSTs. A video that we send out to a lot of people is the ABCs of DSTs. I send this one specifically because it's about a 6 or 7 minute overview of what they are, and it'll help somebody decide right out of the gate whether or not this is something that's good for them. We've got a lot of fact sheets and brochures. So these are things that individuals can use or real estate agents to get up to speed on this. I would say maybe a great way, maybe not the best way, but a great way to start is our DST investor checklist. If somebody's considering potentially doing a 1031 exchange in the future, this is a list of things that they would want to know. And it starts not with DSTs, it starts with their current property. Do they really know what the cash flow is after you account for all the expenses? Have they thought about if they just sold the property and cashed out, what are the tax situation? I've seen situations where somebody inherits a property, they could sell it tomorrow. They don't need to do a 1031 exchange or invest in a DST because they got to step up in basis. So they need to work through some of those issues. Once they've decided, yeah, I think I want to sell this property, then they need to understand 1031 exchange rules. And then finally, the DST and the options, the risks, the benefits, and all of that. So this is a great way for somebody to begin that process of education. We do webinars every week. Let me go to our events page. You can register for any of our webinars that are coming up. The next one happens to be net lease and DSTs, where we compare a net lease investment like a Del Taco or Taco Bell, something like that, KFC, to DSTs, just an escape your state's war on landlords and understanding DSTs, which is kind of what we're covering today. So you can register for these anytime that works for you. And I just was kind of winging it there for a minute. Yeah.
I'm hopping on another computer because apparently the breaker chose to blow out on the one outlet I'm on. So
Wow.
Welcome
Okay.
to technology.
Yeah.
Well, I just want to say thank you, Jason, for your commitment of time and your education for everyone. I trust that everyone got something of value from this. If you have any questions, anything you want to follow up on, feel free to call Jason directly. You can email us. We'll be following up with a link to the recording, a copy of the PowerPoint. And as always, we'll have our next community call next month, the last Thursday of every month at 1 o'clock Pacific Standard. So thanks again, Jason. Thank you, everyone, for your commitment of time here. And I trust that you got something of value, and have an amazing rest of the week.